Good morning and welcome to the Killik and Co market update. It's been another wobbly week for markets driven by concerns about borrowing costs starting to rise. Over in the US, the current interest rate is just 0.25%, and in addition to that, the Federal Reserve is currently buying $120 billion worth of bonds. That has the effect of creating demand for bonds and therefore pushing up bond prices, and that brings down yields, which are a percentage of bond prices. However, over the last couple of weeks, various members of the Federal Reserve have been commenting about potentially tapering down these monthly bond purchases, and that will have the impact of lessening demand for bonds, lowering prices, and therefore potentially raising yields. And as a result of these comments, we have seen market participants starting to sell bonds. Here's a chart showing the US 10-year Treasury yield over the last few years. And as you can see, if we go back to the early parts of last year, there was lots of demand for bonds because people were worried about equity markets, and as a result, bond yields were just 0.5%. However, since then, we have seen selling of bonds and we have seen bond yields starting to rise. This week, the 10-year Treasury yield rose above 1.5%. And this could be bad news for businesses in the US because generally, if they want to issue new debt, they have to offer a premium over and above the US 10-year Treasury yield. So higher Treasury yields is generally bad news for corporates and therefore for economic growth. And then from the point of view of investors, if they can now get a slightly higher yield by investing in the bond market, that means the opportunity cost of holding growth stocks is higher, and therefore that makes growth stocks less attractive. That's why we tend to see a sell-off in growth stocks every time we get concerns about interest rates starting to rise. And that's exactly what we've seen over the last week. Here's a chart showing the S&P 500 over the last year. So in the pink, we've got the regular S&P 500 index in percentage terms, so we can just see the percentage change in the index over the last 12 months. And then in the green, we've got just the growth constituents of the S&P 500 index. So as you can see, if we go back to last February, that's the last time we had a real bit of concern about interest rates starting to rise. And as you can see, we did see a notable sell-off in the S&P 500 growth index in comparison to the regular index. Since then, the growth index has recovered quite well, and in fact it did briefly overtake the regular S&P 500 index. However, this week, as these concerns about rates have started to resurface, we have seen the growth index selling off again, and it's now dropped below the regular index on a one-year basis. So if your portfolio is quite overweight in growth stocks, it's likely your portfolio will have come down in value over the last week. The furlough scheme came to an end here in the UK this week, so we'll be keeping a close eye on unemployment numbers to see if the end of the scheme has an impact on these. The furlough scheme has been very successful in keeping unemployment numbers at relatively low levels. Have a look at this chart here, which shows unemployment levels in the UK over the last 10 years. So you can see in the years following the financial crisis, the unemployment rate did go above 8%. However, during the coronavirus crisis, it's only briefly gone above 5% and is currently at 4.6%. So we'll be watching this closely to see what happens. But at the moment, the main cause of unemployment here in the UK seems to be quite a big skills mismatch. For example, there are lots of vacancies for truck drivers, but we haven't got the people in the country with the right skills for this particular job. So Brexit has really led to quite a big skills mismatch here in the UK, and that's something the government is clearly looking to address, potentially with temporary visas. So again, this will have an impact on unemployment, and we'll be watching these numbers very closely. And finally this week, there's been a lot of focus on internet speed recently. What with so many people now working from home and working flexibly, having fast internet speeds is more important than ever before. And for governments, it's a key area of focus because it will be a key determinant of future economic growth. So we were quite interested this week to come across this map which shows mobile internet speeds around different countries of the world. So countries in yellow are the ones with slower mobile internet speeds, and the ones in the dark pink are the ones with the fastest speeds. So unfortunately at the moment, the UK is definitely at the slower end of the spectrum, and this is very much an area of focus for Boris Johnson's government. Over the next few years, we are expecting to see an exponential increase in the level of mobile data traffic. Here's a chart showing the expected increase, and you can see here in 2021 we're barely even scratching the surface, and that mobile data traffic is expected to increase hugely as we move into the 5G era and as more and more devices become connected to the internet. So this means there is an increasing level of focus on digital infrastructure assets, for example, data centers and fiber optic cables. And over the last few months, we have seen the launch of new digital infrastructure funds on the London Stock Exchange, examples being Cordiant Digital Infrastructure and Digital 9 Infrastructure. So do give us a call if you would like to talk more about these types of investments in a little bit more detail. Moving on to have a look at next week, it's fairly quiet on the corporate calendar, but we have got results out from Tesco and PepsiCo. That's it from us. Enjoy the weekend, and we'll see you next Friday.